a lot of that fiscal deficit is not going, it's not like a big one-time burst of new building and war fighting and things like that. It's more of this long, drawn out imbalance that we're going through. So the initial part was like COVID. That was more like war related. But now the more structural thing is that they've tilted the system so much they can't really get those back under control. And so we have a higher background level of stimulus now, of nominal inflation now, because this, like you said, this is pouring into the economy, despite the fact that we have low unemployment, despite the fact that we have no recession, we're running these very big deficits. So we're almost pre-stimulating before we get a recession, which makes recessions either harder to get or they look differently when they arrive because they have almost like an emerging market like quality to them. If you look at recessions in emerging markets, often the currency is weak enough that recessions just look different because it's a different monetary environment. The denominator is different.
In this insightful analysis by Lyn Alden, we delve into the potential crisis looming over the US economy. With a staggering deficit fueled by soaring interest expenses, the fiscal landscape has shifted towards a more top-heavy stimulus model. Alden warns that despite low unemployment and no recession, the economy faces a prolonged imbalance, akin to a stagflation scenario. Moreover, the highly financialized nature of the economy exacerbates the challenge, as deficits are intricately tied to asset prices. As Alden suggests, this complex interplay between fiscal policy and a financialized tax base creates a formidable tailspin, challenging to overcome.
In early 2022, I was bearish on a number of things. And I started to realize by kind of late 2022 or early 2023 that that fiscal side was reaccelerating things for the reasons you described, that even though we're in an economic expansion, the deficit was accelerating. And a lot of that is because of interest expense. So one of the main differences between a normal fiscal environment and a fiscal dominant environment is that in a normal fiscal environment, where most money is coming from private sector credit creation, if they raise rates, they can slow that down more so than they increase public interest expense. Whereas if you have huge debt to GDP and you raise interest rates, although you do slow down private sector credit creation, you increase the federal interest expense by an even larger number, and that's pouring into the economy. That's expense for the government, but it's income from someone else. And some of that has a non-zero propensity to spend. It doesn't circulate as quickly as say stimulus checks do, but it does circulate in a non-zero way. And so that's actually money that's pouring out to varying degrees into the private sector. So when you combine that with, demographics, kind of like how in the 70s, demographics were a key part of the inflation because you had boomers entering the household formation years. Now you have that on the fiscal side, which is that baby boomers are entering their retirement years. And so some of these programs that were built decades ago with certain mathematical models in mind look different now. And so it's a more top-heavy thing, and that's another form of kind of stimulus. And so I think the risk that we have in the 2020s compared to the 1940s is that it's a more somewhat stagflationary type of thing because it's not a lot of that fiscal deficit is not going, it's not like a big one-time burst of new building and war fighting and things like that. It's more of this long drawn out imbalance that we're going through. So the initial part was like COVID. That was more like war related. But now the more structural thing is that they've tilted the system so much they can't really get those back under control. And so we have a higher background level of stimulus now, of nominal inflation now, because this, like you said, this is pouring into the economy, despite the fact that we have low unemployment, despite the fact that we have no recession, we're running these very big deficits. So we're almost pre-stimulating before we get a recession, which makes recessions either harder to get or they look differently when they arrive because they have almost like an emerging market like quality to them. If you look at recessions in emerging markets, often the currency is weak enough that recessions just look different because it's a different monetary environment. The denominator is different. We saw that before. We saw early signs of the banking system running into issues when they actually were pulling liquidity out of the system. So for much of 2022, we had net drawdowns in liquidity. And if they wanted to follow through with disinflation, when you had banks failing, you could have people lose some of their uninsured deposits. But they didn't want to risk instability spreading through the system. So given the choice between destroying some deposits or backstopping the whole system and providing liquidity anyway, despite still above target inflation, they chose the latter. And if you look in history, that's usually how it works out. They usually choose inflation over either nominal sovereign default or nominal banking crisis, as long as they control their own currency. So maybe if you're Greece, it won't be that outcome. But if you're a country that controls your own currency, that's almost every single time that's the outcome that they choose. Um, Also, the challenge is that all this debt is built on a highly financialized economy. So, for example, um, if you look at deficits, they're highly tied to asset prices. So when asset prices are rising, that's pretty good for tax revenue. And when asset prices start to go sideways or down, that's pretty bad for tax revenue. And not all countries are like that. We in the US, we've tied our tax structures more so to that kind of asset price situation. We financialized our tax base more. And so the problem is, even if you try austerity, and you kind of say raise taxes and lower spending in various ways, that might be effective for a little while, but then the problem is your tax base is probably going to be weaker than you think, and you're going to get a bigger deficit because of that reason, which makes the combination of a financialized economy and high public debt it's a hard tailspin to get out of. And so I think that's kind of the underlying issue there. I think that that's part of why this is looking the way that it is.
Continuing on Lyn Alden's insights, she delves into the evolution of monetary technology and its impact on the global financial system. Alden highlights historical layers of centralization, addressing money friction, and warns against the concentration of power in policymakers' hands. She discusses the rise of new technologies like decentralized ledgers challenging incumbent systems and the gradual destabilization fueled by rising interest expenses.
Sure, and the way I would describe that is that for many centuries, almost every friction in money is solved by another layer of centralization. And so when we think of the history of monetary technology, there's obviously the physical component. As we got better at making shells or better at making grains, they became diluted as money, whereas and things gravitated toward gold and silver because those are the commodities that it's harder for us to make more of even in an industrialized setting. It's hard to make them at a rapid rate. So there's that physical component, but then on top of that, there's all the banking technology. And that started with technologies that we don't even think of as technologies today because they're so straightforward. Things like coinage, things like paper, bookbinding, the printing press, analog encryption techniques, so you can't have like papers be copied and forged. Those are all analog layers on top of it. And then you, of course, had digital layers, things like the telegraph, the telephone, the internet, blockchain, right? These are all technologies that are an additional layer on top of these things. And, for most of human history, both transactions and settlements were slow because everything was moving at the speed of matter. That was pre-telecom. Now, once the telecom era began, which I kind of define as the 1860s or 1870s because they invented the telegraph in the 1830s, but then it wasn't really kind of run long distances until the 1860s. That's when we kind of entered the kind of developed world entered that connected environment. And so now we were in an environment where transactions could move at the speed of light because all that takes is fairly low bandwidth information. But settlements, things like physical shipment and verification of gold, was still slow. And so in that pre-telecom era, the usefulness of middlemen was limited. They were solving problems, but in an analog way, and they were more optional to use. Whereas in that kind of post-telegraph environment, because settlements were slow and transactions were fast now, those middlemen were doing a lot of work. The banks, the central banks, they're serving as that abstraction layer on top of that much slower layer. And there really wasn't a lot of alternatives. Basically, you had to trust someone's ledger and they kind of went down the stack. So if I wanted to send money to you for some sort of commerce, we could use the same bank and just use them as a trusted intermediary. If you're using a different bank than me, then our banks have to be able to communicate. And so eventually they have a central bank under them and they can just like I can just tell them to send money to you, they can just tell the central bank to, debit their account and credit the other account. And then you have an issue of how do central banks around the world coordinate if we're in different countries who want to send information? Well, what they do is they coalesce around the biggest central bank. So in the 1800s, that would have been the UK. Now it's the US. But all those kind of major central banks tie into the biggest one. And so you have individuals built on banks, built on central banks, built on the biggest central bank. And it's just layers of abstraction. And it's all really solving that mismatch between fast transaction speeds and no quick way to final settle value. Um, and so that's kind of the era that we've been in. But the problem is when you have that power coalesce down to central banks and policymakers, and especially a couple key major central banks, that over time tends to degrade. Whenever there's a problem, they tend to resort toward debasement. It's generally a smoother solution than raising taxes or cutting spending, which is very popular. An example we just discussed, when the banking system ran into issues in early 2023, instead of saying, look, I mean, if you had uninsured deposits, they might be gone now, or you might get 80 cents on the dollar, and that's the risk you took. Instead, they say, no, we don't want this to spread through the system. We're going to add liquidity even though we have above target inflation. We're going to back deposits even that weren't fully insured. Because that tends to be it's like accumulation of those little decisions over time. And so now we're in an environment where decades of those decisions led to very levered middlemen, let's say, very levered governments, very levered central banks. And now we have new technology that allows us to do fast settlements for the first time. We can do fast settlements long distances internationally. We can run a decentralized ledger. It came about as early as it could because you can't really do that until bandwidth and encryption techniques and overall global connectivity got to the level that it did in the past couple decades. But now that's there. That's a new alternative that's being tested and is kind of like a new challenger up against that older model. And I think that what we're seeing now is this ongoing friction point where you have this new technology, but you have, of course, challenges building it, scaling it, and testing it, and fitting it into existing regulatory structures. That's all happening on one side. On the other side, you have just decreasing stability from the incumbent systems because the results of all those accumulated decisions have really built up to a point where it becomes critical. And I think that the point that's really worth emphasizing is that for 40 years, let's say in the US, we've had rising debt to GDP publicly and falling interest rates. And that's been a kind of a one-for-one offset. And if you double your debt, but you cut your interest rate in half, your debt service remains the same. But after 40 years, if you run into zero and bounce off zero and start going sideways to up in terms of your interest expense, while you still have that structural deficit, that's when that actually starts to become more acute. And so I think that's the phase we're in now, which I think is still a fairly long phase. So basically, we have a gradual destabilization of the current system, and along with new technologies that people can turn to, with a lot of friction in between.
Today's discussion has shed light on crucial insights into the evolving dynamics of the global financial landscape. We explored how fiscal policies and demographic shifts are shaping economic trajectories, alongside the impact of technological advancements on monetary systems. From the implications of rising deficits to the emergence of decentralized ledgers, each point underscores the complexities facing modern economies. We appreciate your engagement and encourage you to subscribe to stay updated with more insightful content. Don't forget to like and share this video, and feel free to share your thoughts in the comments section below.